So today I'm going to highly recommend, of course, I always think that you should do this, but I'm really going to recommend that you hang around until the end. I found a couple of truly insightful articles that I think will help all of us think about the near and the longer term with regard to our investment strategies. Also, at the start of the show, 4:10 California time, there's no response from Israel so far with regard to Iran. And so the markets are marginally positive. We'll check that again at the end. And of course, the markets are going to be dramatically affected by that tomorrow morning. If there's no response and Israel seems to be turning the other cheek, so to speak, and saying, okay, enough is enough, then that will certainly be good for markets. On the other hand, if they strike back, depending on that strike, obviously that could change things in the other direction. All right, let's start with this. This is really, really good from Gary Black. Now, no matter, I know some of you in this community, the ones who specifically follow my channel are no fans of Gary Black. I happen to think he's a very smart guy, and he has a huge product background with major national companies that are, that have big time brands. And he's got some ideas here, and I like a lot of what he has to say, and then I'll add my thoughts at the end. He says, many have been asking us, meaning his company, why we think Tesla delivery growth has suddenly stalled in 2024 after good increases, obviously, for the last 10 years. We believe that there are four factors that have contributed to this. Number one, the early adopters have already bought EVs, many for environmental reasons. To get the next cohort, he calls them rational pragmatists, to buy, Tesla must help overcome range anxiety by communicating the breadth of its supercharger network and by showing consumers how easy they are to charge, like plugging in an iPhone. Range anxiety is why hybrids have suddenly become so popular, which hurts BEV growth. Now, at this point, I think Gary has got it partially correct and partially wrong. For the most part, people in California don't have a problem with range anxiety, but the rest of the country has been, all they've heard really about is the other brands. And they've heard how horrible it is in terms of getting those charged at superchargers or other kind of charging situations. How long it takes, how you can't find them, how they're broken when you get there. So this is not a Tesla problem, although the education would be Tesla's opportunity. But Tesla has done a great job on charging stations, and of course, they have a great network. So yes, I agree. This is one of the biggest things impacting Tesla's ability to go nationwide after getting a huge market share in California that should start to move to the rest of the country and might start doing so as the word gets out. Number two, his potential EV buyers don't realize how inexpensive Teslas have become, with Model Y starting at $37,500 after the $7,500 EV credit, and of course, Model 3 is even less. So he says, after we get through the early adopters, Teslas don't just sell themselves. The early adopters are telling their friends and their friends, blah, blah. But at a certain point, you no longer have those cheerleaders out there. You just have people that buy a car, and they're not necessarily just going crazy telling everybody. Non-EV owners require education. He's, of course, been on this for a long time. Totally agree with him. I think that there needs to be a lot of education. I would like to see much larger budgets. I would like to see what the budgets are doing right now. How impactful have they been? I'd love to see what is happening with all of that. But yes, at this point, I don't think there's any reason at all to cut prices ever again. In fact, I think you could start easing them back up just a bit, maybe even more than a bit. But there's other ways to skin this cat right now. I don't think lowering the prices is going to do the job. Number three, he says ubiquity is a dual-edged sword. In the beginning of a growth wave, ubiquity helps overcome fear of buying into a new technology, acting as a stamp of approval. Maybe I need to explain what he means by ubiquity. That means seeing others on the road with the same vehicle, seeing that there's at least some out there. Now, for me and for many of you, maybe the fact that you've got something different is a stamp of approval right there. And at a certain point, though, there's folks that want to see that others are buying it before they're going to jump on. One way or the other, they need to see it among their friends, or in this case, maybe out on the road. But at a certain point, it becomes a negative, as many consumers don't want to drive the same car that everyone else is driving. Don't necessarily agree with that. How many Corollas are out there? How many? I mean, holy mackerel! How many Ford 150s are out there? I mean, I really have a hard time with Gary's analysis here. I think there's some truth to it, but I think that we're nowhere close to that number anywhere but maybe in Los Angeles or a few San Francisco, a few of the California cities where it's just crazy. Anyway, but I'm not even sure it's true there. But anyway, in 2023, Tesla became the best-selling automobile in the world, so there is some ubiquity taking place. Number 4, more EV choices. From 2017 to 2023, Tesla's had EV playing field itself, could sell every EV it produced. Now every auto brand family, Hyundai, Kia, Ford Mach-E, F-150, GM, Chevrolet, Cadillac, etc., has EV sub-brands, and unlike Tesla they advertise them heavily. In China, the price war was started by Tesla in 2022, has become brutal with many new under 20,000 EVs launched over the past few years. Okay, I think, again, this is a yes and a no. In China, I do think that there's a lot of good competition. I think Tesla is up against some competition, and there's methodologies for dealing with that competition in China that are going to be a lot different than what you're going to do in the US or in Europe or in Australia or anywhere else. But in the United States, the competition is still not an issue, not even close to being an issue, with Tesla having something around 60 to 70% market share, with all the things that are coming in terms of the Cybertruck and whatnot, providing massive halo effect. I just don't think we just don't have a problem in California with these EV choices. I'm sorry, in the United States. Also, probably not in Europe. So 2 non-factors mentioned by some of his reasons Tesla's growth has stalled are 2 additional reasons. He says personal brand and higher interest rates. He says they don't buy the argument that Elon's increasing polarization, Twitter views negatively impact Tesla. He doesn't believe that Elon being political and putting up a bunch of posts on X is a problem. He says, we know of too many EV owners who both hate Elon Musk politics and love their Teslas. On the other side of the ledger, we don't believe higher interest rates are a factor because the economy has been strong and unemployment low, which is far more important than the impact of higher interest rates. Housing starts remain near their highest levels since before COVID, even with high interest rates. Well, okay. Again, I agree in part and disagree in part. I think that there are a few people that are not buying Teslas because of the political stance. I think there are a few people that are buying Teslas and might buy them in the future because he's turning more conservative. On the interest rate thing, I've said for a long time, these interest rates are not crazy high. And therefore, I think people will get used to them. But I do think there was a shock. I do believe over the last 18 months, people have been shocked by the interest rates. They've not adjusted to them yet. And if they stay higher for longer, I believe it'll become less and less of an issue. All right. He says, we have seen estimates of first quarter BEV growth of 15 to 20%. Tesla could buy down high auto rates to 2 to 3% rather than cut prices. I agree 1,000% with that. I totally feel that's what he should do. And I also think they should really, really push the leases. And I think they should end the issue. I think they should start allowing people to buy the cars out at the end of the lease. Let's see. I think that's it. The other thing is, the other thing that I think is really hurting Tesla still, very big, is there's a huge percentage of the US population hates anything smacking of global warming, climate change, or green, and especially any evidence that the government is putting its finger on the scale to mess with capitalistic markets in order to help those issues. Tesla is swept up in that for a great number of folks, even in California. How do I know this? Because my friends and family feel that way, okay? So some of yours, let me know in the comments. Do you think this is an issue? I think it's a massively huge issue in the United States. I think it is having a big impact on Tesla's ability to get sales going outside of California. All right, this is Randy Kirk, by the way. Hit the like button, please. Hit it. Hit the subscribe button and then hit notify, because tomorrow Larry will be back for sure. He's been out traveling and trying to get settled in the south of France someplace, and he promises me tomorrow everything will be solved and he'll be able to be on. And then we've also got Brian White. I promise you, Brian White show, as always, will be amazing. So that's why you need to hit notify. And then maybe, I don't know if you've seen our Elon, I'm doing the X Post show, the Elon X Post show every day, usually in the morning, usually before noon. Lots of people seem to really like it. I'll talk to you more about that, put up a card. All right. And then, of course, Patreon. Lots of folks joining this month. Thank you very much. And we're going to start naming names. Yes, we're putting together some stuff, and we're going to start rolling some names out there of just exactly who these Patreon folks are. Okay, it's been 2 years since forecasters felt this good about the economic outlook, according to the Wall Street Journal. They did this survey. So here's the first of these articles I was telling you about. This is going to go a little long, but it is worth every minute of it. In the latest quarterly survey by the Wall Street Journal, business and academic economists lowered their chances of recession within the next year, not just the rest of this year, within the next 12 months, lowered their chances of a recession to 29% from 39% in the January survey. It's the lowest probability since April of 2022, when they set that level at 1% less, 28%. Now, you know my theory. One of my theories about anything is when you get out too far in one direction, it's time to get nervous. So the fact that you have so much optimism among these economists is one issue to take into consideration. In the opposite reality might be true, okay? But that is interesting in itself, that's how they feel right now. Economists, in fact, don't think the economy will get even close to recession. In January, they had an average forecast of sub 1% growth in each of the first 3 quarters of this year. Now they expect growth to bottom out this year in the third quarter at 1.4%. So they're in fact, just 10% of survey respondents think the economy will experience 1 quarter of negative growth over the next 12 months, down from 33%. So that is from 33% to 10% that don't even expect 1 negative quarter. Now, the third quarter is going to be very, very hard. So we'll see what happens then. But that would not mean recession. That would just, if 1 quarter, that's not a recession. The Wall Street Journal survey was conducted from April 5th to 9th, which was before the release of the March Consumer Price Index, or Friday's consumer confidence. So those 2 things happened after, which are pretty significant. The U.S. economy has so far outperformed expectations over the last year and a half, definitely. Instead of stumbling, it's been doing great. All right. Few think the economy can do quite as well as last year's 3.1% growth, but the figure might have been boosted by such factors as federal infrastructure and semiconductor legislation and an uptick in immigration. An uptick in immigration? How about a massive increase in immigration, which might not last? How's it not going to last? It'll last until this administration's out of office. Anyway, still, economists have had to rethink forecasts for a major slowdown as more time has passed and one still doesn't seem imminent. Economists on average think the economy grew at a 2.2% rate the last 3 months, the first quarter, and that is up from the 0.9 forecast that they made in January. The U.S. economy is performing very well, according to economist James Smith. We are truly the envy of the world. That is true. Much has changed since economists were last this optimistic. 2 years ago, the Fed's benchmark federal funds rate was between 0.25 and 0.5. Inflation was high, but economists still generally thought it was transitional, blah, blah, blah. Now the Fed funds rate is sitting between 5.25 and 5.5, and economists don't see a bunch of cuts coming soon. Many analysts trimmed their rate cut forecast after last month's hot inflation report, but even before the report, survey respondents predicted that rates would end up the year at 4.67, implying 3 cuts at the very most. In January, their responses suggested they thought 4 or 5 cuts were likely. We all know about that. Economists now think the economy can withstand higher rates than they did not long ago. Let me say it one more time. Unless you are under 50, maybe under 45, you remember that interest rates were much higher than this for mortgages and for cars for 25, 30 years. So this is not a new idea. We grew fantastically from 1983 until 1990, given much higher interest rates. So this is about the interest rate shock more than it is about, and we'll talk more about that later on this conversation. Many economists have long thought that the economy can handle higher interest rate. To that end, economists expect the Labor Department's measure of productivity to rise at an annual rate of 1.9 over the next decade, 1.9% over the next decade, which matches the annual increase in productivity over the last 40 years, above even the 1.2 pace of the 2010s, when the 10-year Treasury yield was typically stuck between 1.5 and 2.5. Yeah, interest rates don't have anything to do with productivity. The productivity that was amazing was between 1990 and 2000, when interest rates were high. Some economists are now enthusiastic about the economy's longer-term potential. We think the American economy has entered a virtuous cycle where strong productivity results in growth above the long-term trend, inflation between 2 and 2.5, and an unemployment rate between 3.5 and 4. Okay, this is just such nonsense. This is such economist talk. Listen to somebody more like a Cathie Wood, who's thinking about this thing holistically. Either we are going to have a revolutionary situation with all this AI, and we're going to see productivity that goes through the roof, and that productivity going through the roof is going to result in deflation, but of a good type, where your television, your 85-inch television that's now $1,000 is going to be $495, or we're not. And I happen to be among those who believes that things like robotaxis and Optimus robots are going to drive amazing changes in productivity. Many aren't quite as optimistic. One downside of a better growth outlook is that a stronger economy could make it harder for inflation to fall all the way back to the Fed's 2% target. An inflation gauge that is closely watched by the Fed, the core personal consumption expenditures price index, was 2.8 in February. The most recent reading, economists now expect it to end the year at 2.5. Economists on average believe that the core PCE inflation will fall to 2.1 by the end of next year without a recession. Nothing ever happens over that amount of time. You're talking about over 2 years, and you're making this prediction that you're going to drop it down. That's just not going to happen. One way or the other. It's going to go one way or the other. It is either going to reaccelerate or it's going to drop probably well below 2%, unless the Fed is able to feather it and make all that happen. That would be very good, but it's rare that they can feather it for that long without something coming in that impacts it. So I call nonsense to that. Great, make the prediction. I'm okay. The risks are clearly skewed towards more hawkish Fed outcomes, which could drag down our growth forecasts. According to Deutsche Bank's Brett Ryan, the Wall Street survey was answered by 69 economists, but not every economist responded to every question. The big question, as I continue to harp on, is whether the consumer will keep spending. They didn't talk about that at all. And so we're going to talk about that next. We've seen the stats on consumer confidence drop big time. They dropped big time last week. And now contrast that optimism from the Economists with this. The Kobesi letter has this. Just in, U.S. credit card delinquency rates are now at their highest on record, according to the Philadelphia Fed. In quarter 4 2023, more credit card balances were 30-plus days and 60-plus days past due compared to any other period in history. And that was in quarter 4 of last year. I don't think it's going down since then. The percentage of credit card balances at least 30 days past due is now 3.5%. Meanwhile, total credit card debt has skyrocketed in recent months, is now up to 1.3 trillion. I think, yeah, okay. So credit card debt is not the solution to inflation. Credit Watch has this from Susan Collins, Fed chief from Boston. Now, Susan Collins is usually considered to be very conservative and hawkish at the same time. I think she's on point about this consumer. She says it is very important to watch the consumer sentiment, and she's been out among those consumers trying to get a sense of what they are actually seeing. And here are some of her thoughts. Uncertain environments are very anxiety producing. So you have uncertain environments, uncertainty about who's going to win the White House. And nobody's really, I mean, when I say nobody, a big percentage of the population isn't thrilled with either choice. You know, my politics, get my politics out of the way. Most of the country is not excited about either choice. Can we agree on that? Comments below, let me know. I think everybody is very uncertain and unhappy that these two gentlemen are so old. And I think that there's a big percentage of the population that might believe that one or the other would be better than the other but they're still not thrilled about either choice, more so than usual. So people are saying that they're uncertain. Their uncertainty is making for anxiety. What else are they uncertain about? A war in Ukraine, a war in Israel, boats being bombed in the Red Sea, the Straits of Hormuz, the Suez Canal, all potential really points that could really hurt the economy in the short or the long term. What else are they concerned about? Well, things have been going when things are going pretty well at your job, but now you're starting to hear, oh, I hear there might be layoffs. That's what people are hearing right now, that there might be layoffs. She says, I think part of what people are telling us is that the toll that it takes to deal with that uncertainty is what's going on right now. Collins said she's been concerned about a scenario in which cynicism spreads and more consumers and businesses tighten their purse strings preemptively, creating a self-fulfilling prophecy that could drag the economy downward. One of the little things, I shouldn't say little things, one of the things that I think is important to watch for is the dynamic that ends up being self-fulfilling, where it causes a number of other folks to pull back in ways that slow the economy because people are worried about everybody else. So they're looking around and they're going, yeah, things don't look so great. That person tells me it's that. And then all of a sudden they start pulling back. That kind of cycle could be spurred by something like some high profile layoffs in a particular sector, which we're seeing already to a certain degree in high tech, and it could obviously impact other areas as well. The concerns Collins hears most frequently: one, housing remains a big concern, she says. Most frequent thing I hear when I'm talking to people across New England is the challenges related to housing. Collins said she heard multiple stories from employers who lose out on new hires because those workers can't find a place for their family to live in the area. These kinds of challenges are showing up across all income levels. What else is keeping a close eye? Extra savings that many households accumulated during the pandemic seem to have dissipated, but savings rates remain really low. So they've used up those savings, but they haven't started putting more into savings. That's another area of uncertainty. Okay, third article. I said there was only two. There's three, but stick with me. This is about the consumer. The consumer price, this is from The Atlantic, okay, no conservative magazine. So when they talk in this, you can assume this is shockingly stated from a conservative viewpoint, even though it is The Atlantic. The consumer price index for food rose 25% from 2019 to 23. Pretty much everything is up. I mean, the average is up. The jump in 22 was the highest. In 22 was the highest since the late 70s. As of 2 years ago, Americans spent 11% of their disposable income on food, the highest share in 3 decades, according to the U.S. Department of Agriculture. In fact, it had dropped under 10% and now is back over 11 and is now moving upward again. It's continuing up as a percentage, just not in total number dollars. It's going up as a percentage of their income. Food price inflation falls most heavily on the poorest 20% of Americans, who spent nearly a third of their income on food in 2022, the latest year for which USDA data are available. By contrast, the highest income fifth, they only spent about 8%. If you're spending 25 to 30% of your income on food and price, and if you're spending 30%, imagine, think of your own situation. If you were paying 30% of your income on food and prices jumped 25%, that would give you some real pain. That would give you some real pain. It would give me some real pain. I asked one of my children what they were spending, and it turned out to be right about 9%. And they are not poor. They're spending right about 9% of their food right now, of their income on food. Mine is way lower than that, but there's only 2 of us. Other staples of life have also grown more expensive. Gas prices have gone up by about 50% in the past 4 years. Fuel oil prices jumped by more than half from March 2020 to March 2024, and they're still going up right now and unlikely to be tailing off before midsummer because, that's kind of the trend. Well, those extra costs keep mounting. Interest payments on new cars have risen 80% since the pandemic began. Credit card interest rates are another burden. In March 2022, before the Federal Reserve started raising interest rates in response to inflation, the average credit card rate was 16.3%. a crazy number already, according to Bankrate. 2 years later, the average is above 20%. Now, who's that hitting? Again, it's the poorest. It's the poor and the middle class. Those are the ones that have credit card debt, and they're paying this 20%. The article warns, this is their warning to liberal economists, it says. This is a liberal magazine warning liberal economists. They make a big point of that, okay? They say to those liberal economists that are complex, they're perplexed. They can't figure out how consumers can be so unhappy in such a good economy. And it says, you guys are out of touch. That's what it boils down to. You are really, you're thinking about what's happening in your own house and you're looking at the numbers, but you're out of touch with reality. You're out of touch with the folks. All right, what's coming this week? Okay, on Monday. Okay, first of all, I'm not going to give you all of the different times when the Dallas Fed, the various Fed speakers are going to be out next week. Just let me tell you, they're going to be out a lot. And my expectation would be, I don't think we're going to hear good news from any of these from Dallas. I keep saying Dallas because it's the first one. Dallas President Lori Logan speaks in Tokyo on Monday. But anyway, Fed speakers are not going to be delivering good news this week. It's not going to be something that's going to quiet the market. All right, but we have the Empire State Manufacturing Survey, which last month was down 20.9. They're expecting that to be down another 10. And yet most of manufacturing is doing well. What's going wrong with the Northeast? Then you have U.S. retail sales last month were up 0.6%, only expecting another 0.3% this month. That would only be about the same as inflation because that is not an inflation adjusted number. Retail sales minus auto was up 0.3% last month, expected to be up 0.5% this month. What does that say? It says, once again, auto is going to be down. If you got a 0.3 for everything, but 0.5 for retail minus auto, that means auto is either like 0.1 or 0 or underwater again. New York Fed President John, business inventories will be out also on Monday. They were flat last month and this month expected to be up 0.4%. We saw the wholesale inventories were up a while ago, so that's probably why they're making that particular guess. The Home Builder Confidence Index, they're expecting that to stay even at 51. Last month it was 51, slightly above water. And they're expecting it to stay even at 51. I would not be surprised to see that go down, given the higher for longer thinking. Yeah, I'm thinking that's going to be down, but we'll see. We'll see what happens. Housing starts. Last month was 1.52 million. This month, 1.47 is their expectation. Not sure why. Last month, building permits was 1.52. They're expecting that to be down as well. So why, if housing starts are going to be down and building permits are going to be down, why would the confidence among builders be up or stay flat? It would seem to me that would indicate what I was going to say. Industrial production, this is also on Tuesday. Last month was up 0.1. They're expecting that to be up 4%. Something's wrong there. I think they made an error. Let's not report that. Okay, let's just say that we're going to learn what the industrial production number is this month. I'm expecting that to be maybe up a tad, not 4%, that's for sure. Capacity utilization last month was 78.3. They think that inches up to 78.5. I think that could be true. I will mention that Jerome Powell is speaking on Tuesday. So that, of course, is always interesting. Fed's beige book on Wednesday. That'll be coming out at 2 o'clock in the afternoon. So we will report that Wednesday evening with Jeff Lutz. Thursday, we've got initial jobless claims, which was 211 last week. I'm sorry. They're saying about the same, 210,000 this week. I have no reason to think otherwise, and they never get it right. So Philadelphia Fed manufacturing survey comes in last month up 3.2. It was a startlingly good number. This month, they're thinking that's going to be flat with no change. Existing home sales comes in. Then later was 4.38 million last month. They're saying that they'll drop dramatically to 4.11. That could be true. We've been hearing a little bit about softness in some parts of the country, but also that there's no inventory. So that continues to be a problem. Then the U.S. leading in economic indicators comes in. Last month, it was up 0.1. They're saying that's going to come in at flat also at 0.00. So leading indicators has been down, and nobody can understand why. So we'll see what happens with that one. I'm going to dig into that one a lot harder this Thursday. And then only Fed President Austin Goolsbee speaking on Friday, no other reporting on Friday. Oh, there's a bunch of banks this week. I forgot to look this up. There's a bunch of banks, and obviously there's other earnings coming out this week. Put it in the comments below if you know that there's a major companies that we should really be paying attention to that are reporting this week. I'm so sorry. It's so much already in this particular report. All right. So what's going to happen to markets this week? As mentioned earlier, it's going to be largely dependent on what Israel and Iran do. People are still recovering from the CPI and PPI reports last week, and the consumer confidence on Friday. All three not good. But the markets, well, we'll look here in a second. If there's no strike back by Israel, if they decide to say, okay, enough's enough, then I think the markets will probably respond to that positively, even if they're kind of in a bad mood. Generally, there might be a relief rally, they call it. What will FSD? Well, if there's a relief rally, I think Tesla will do well. They'll continue to get the benefit of this FSD news that is just constantly, and the robotaxi news. All right, let's take a look at the markets. Okay, we'll look here. We have got, okay, whoops, I went the wrong way. Bonds. Okay, up 3.5 basis points, 3.3 basis points on the 10-year. Do we have the rest of them yet? Yes, we do. Okay, so that's the 10-year. The 2-year up only 0.11. I'm sorry, 1.1. Yeah, 1.1, not 0.11. So 3.5 on the 10-year, 1.1 on the 2-year, and up 2.1 on the 2-month. So generally speaking, all those being up, bonds being down, that would say positive things about the economy, but also negative things about inflation. So there you go. We'll go to oil next. Of course, oil, we would be expecting it to go up based on what's happening in the Middle East, but in fact, it's flat. Again, probably waiting to see what happens next. Natural gas flat also. We've got the whoops, holy moly, things are all out of order here. Gold, flat. Copper up 2.15%. Okay, I'm convinced now. All right, it doesn't take much to convince me. I really need to look into this more deeply. I think this copper move is going to be not a secular move. It's going to be a consistent, constant move to the upside over time. Now, how much will that be in order to take into consideration all the copper that's going to be needed for these data centers? I'm not sure, but let's take it. Maybe one of you knows a little bit more about this than I do. Please put it in the comments below. Okay, we got the dollar jumping on central bank divergence. It says here, dollar jumping. Bitcoin down 536. It had been down so big yesterday, so it's really kind of back from that 65,720. And then the equities, you've got the Dow up 96 or 0.25%, S&P up 16.25 or 0.31%, and then NASDAQ up 60 or 0.33%. So all three around that 0.30% up in the pre-market. All right, I think then all you need to know at this point is that if you haven't checked out my Elon's daily posts, my ex-post episodes, here's what some are saying. GG Miller 2707 said, great content, Randy. Mr. Ed, oh, and then he says enjoy. And then Mr. Ed 2291 says, right now, hearing of all of Elon's comments is still fun for me, he says. And then we have, oops, I didn't get this guy's name down. Oh, anyway, he says, love the content, Randy. I'll put up, and then what I'm going to do is I'm going to put up a card for you to go check out today's version. Okay. And then after, if you go check out today's version of the ex-post file. It's another good name for it. Ex-post facto, ex-post file. Anyway, yeah, maybe we'll come up with a name for it yet. All right. And then Again, hit like, subscribe, notify, and we will see you tomorrow morning for After the Bell. Then Brian White and then Larry Goldberg has promised that he will be available from the south of France. It's been great talking to you.